So we are, John, we're simultaneously on Facebook and YouTube live right now. I just want to make sure that I need to know on Facebook, can you hear my partner, John? John, introduce yourself.
My name is John Brucker. I'm Gizzy and I've been working together since 2012, roughly thereabouts.
Do you hear him? Do you hear John? I need to know if you hear John clearly. Please comment below. Thank you, Michelina. Thank you. You comment below. Yes, you can hear John. Okay, John, they can hear you loud and clear. Good. All right. So I labeled this video how to get your credit mortgage ready 2020 and regular credit education, John. So I want to introduce John because John has been my partner with all of my credit repairs. All of the videos that you see of me giving people fast results, it actually has been John. Me and John work together, okay? He does his thing. He has his company. I have my company, and we work together to help you out, the consumer out there. So just make sure that John is an expert in financing. He's a real estate investor. He knows he knows a lot about just finance in general. He's been put in different situations in the last 15 years where he knows how to have a conversation and talk to everyone about how credit works. Do me a favor, my YouTube subscribers. I have 5 people online. If you could just like the video and share it, that's the way that you can help my channel and help us grow. See more people get education from us is key. This could be a 20-minute conversation, 30 minutes. It's all up to you. Seeing if you could want to ask questions, it could be an hour long. But the main topic for today is going to be how to get your credit mortgage ready in 2020. So just I want to say hello to everyone on Facebook. Maricel, Ruel, what's good? Let me see my people on YouTube. Both good dudes. Thank you, China. Mohammed, what's good? How you doing? Hope all is well. All right, John. So how are we gonna how does someone get mortgage ready in 2020 with your experience?
Right. So, I mean, I think this whole idea kind of stems from the fact that, our last 2 live podcasts, for lack of a better term, were well received, and a lot of the information we were giving, obviously shine light on areas maybe that the natural consumer doesn't entirely understand. So, the goal of these is obviously to educate and empower, some of our clients, potential clients, and give them a little more transparency, obviously, in our overall understanding of what we're doing, but more importantly, of things they may not totally understand. So one of the things, and we actually had a call with a client today. We were on for a while, who is preparing to buy a house, because a lot of our clients are buying houses once they're ready. And there was just a lot of misnomers as far as her understanding and what her real estate agent had told her, and the confusion surrounding even the broker she was dealing with at the bank. She said, this is probably a good topic to discuss, just in the way of maybe clarifying some obvious nuances, that because everybody's got a different level of understanding as it applies to just the mortgage process as a whole. So we figured we might as well just kind of touch on a lot of these important points and let it just run from there. So at the very basic level, and Gizzy, feel free to cut me off if you want to take it in a different direction, okay? But at the very basic level, there's a multitude of different types of mortgages. There's the conventional, which basically fall in line with your FHA, your VA, your typical conforming. Then you have your jumbo loans.
All right.
And then you have obviously the non-conforming, unconventional loans. I'm going to break down each one of them little by little, just to give a little bit of a better understanding. So VA loans are strictly for veterans. They're the most flexible underwrite. The underwriting is the most flexible. Your FICO score can go down to 580, and it allows them a lot of flexibility when they're going to qualify. And obviously it's deserved. They're soldiers and they're veterans, and they deserve that kind of a credit for what they did for our country. Now, on our end, anybody that's not a veteran, there's the FHA, which is probably 70 to 75% of the total amount of loans that probably go on. Maybe a little, maybe a cut less, but it's the least amount of bonds, 3.5% down right now, and it's the program that's probably most widely used. Then you go into jumbo. Then you would go to a conventional loan, which is right now going into 2020. The conventional limit is anything under $510,000 is considered a conventional loan. So you could go the conventional route, which doesn't have the same down payment flexibility that an FHA loan would, because typically when you're going the conventional route, the least amount down is typically 5 to 10% on average. And then you go jumbo, which a jumbo loan is anything over 510. And basically typically what ends up happening with a jumbo loan, you put 10% down, and they do an 80% first, meaning 80% of the purchase price. Then they'll do a 10% second, which will leave you, 10% to put down on the process. Now, the area that we got a little confused with the client today was that the client had an alternative scenario where, she could document through through her bank statements. And, her tax returns don't necessarily tell the story. And nowadays there are unconventional lenders that will go that route where they work strictly off of, as long as your credit's good enough, they will work strictly off of your bank statements in order to substantiate an income that they can back into, as far as establishing a debt to income ratio. So in doing so, we had to kind of walk her through that and give her kind of the nuances of that, but it does go that far out. Now, again, without numbing anybody too specifically with too much minutia, I think some of the bullet points we wanted to talk about were the first establishing, everybody's got a different understanding of what a FICO score is. So I think it's important to establish exactly what a FICO score is. The FICO score is the middle score of the three scores. You have three scores between Equifax, TransUnion, and Experian. Your FICO score is the middle score always. Okay, it's if you for some reason only pull two bureaus, let's just say you go to a mortgage lender or a bank and they're only able to pull two bureaus for some reason, your FICO score is the lower of the two scores. Which is typical, they pull all three, it's always the middle score of the three. That's not specific to any bureau. It's just whatever bureau is in the middle at that time, that's the FICO score that they utilize in going forward. So,
hold on. Even a credit union that is Equifax only, when they go for a mortgage, they're still going to pull all three, even though they're Equifax only. Is that correct?
Correct. Yeah, they're still going to pull all three because they need to establish the FICO.
So the only way they will run one bureau is if you're trying to get financing through like one of the products?
The only time they're going to pull, for all intents and purposes, they're only going to pull one bureau they could pull one bureau when it's a line of credit, even a home equity line of credit, a credit card, auto loan, etc. But there's certain banking guidelines that require post-Dodd-Frank, whether you're a credit union or a federally regulated bank, you still have to pull a FICO score. It's out of protection of the consumer overall. So with Equifax-only lenders, every product other than the mortgage is all Equifax in most cases. But even with the mortgage, if it's a first mortgage, you would expect to still have to establish that FICO score by utilizing the three bureaus. So I think the other thing that's important is trying to establish a debt to income ratio, right? The term behind debt to income ratio. So, the debt to income ratio is essentially right now on FHA loans, I think they go up to 55%. So we talked about this in one of our live podcasts, last week, but just to focus solely on it now, if somebody made, for argument's sake, $10,000 in gross income a month, the bank will essentially that 55% or that income number basically works off of that. So, for instance, 55% of $10,000 in gross a month is $5,500. Right. That $5,500 number is essentially utilized from that point forward for the purposes of a mortgage payment and all your bills that show on your credit report. So those bills on your credit report would essentially be your auto loan, any school loans combined, the total payments on them, any personal loans, any credit card minimum payments. It's not the total amount outstanding, obviously, on the cards. It's just a minimum payment. So once you go through your credit report and you add all those numbers up, whatever that number is gets subtracted from, in that example, I just provided the 5,500, and the difference is what you can use towards your mortgage. So for argument's sake, let's say you have $2,000 in monthly debts based on what we just talked about, and if you had $5,500 after the debt to income ratio of 55%, that would leave you approximately $3,500 left over towards your mortgage. Now at 3.5% right now, you're talking about towards that 55 minus 20, 2,000 is 35. So you're talking about a $900,000 house, roughly, using those scenarios.
If you make $10,000 a month.
Yeah, well, with that amount of debt, right? So leaving over about, you're going to have left over about $3,500, assuming it was a $5,500. $10,000 at 55%, I think almost $5,500. If you only had $2,000 in bills, it leaves you $3,500 left over. $1 million at 3.5% is roughly, $3,500 principal, interest only. So if you add in some principal into that, before you back out for taxes and stuff, you're probably around a $900,000 mortgage. The problem that people experience, though, is when people make that amount of money, they normally lever up. You understand what I mean?
Correct. They live in a more expensive apartment. They have a higher.
Exactly. They just load up, which is the problem we're dealing with right now with school loans. Is that people lever up? They defer all their school loans on the front side, right? And then they lever up. So when those school loans come due and all that deferment is out, there's no money left.
Correct.
And it's just natural. It's how our banking world tries to get people. They try to lever them up as high as they can so you can make as much profit as possible. In this case, it's rare you'll see an instance like that, right? Where somebody, is making $120,000 a year and they only got two grand going out the door, which leaves them over that amount. But it can happen, right? Roughly based upon those numbers and how low interest rates right now are with mortgages. But the other thing I think that's important to talk about as far as the mortgages is is PMI, because I think there's a huge misconception relating to PMI. So the idea behind PMI, which stands for primary mortgage insurance, is that any mortgage that's financed over 80% naturally gets PMI. So if you finance a house 85%, essentially what happens is the bank takes out an insurance policy for any amount over the 80%. So for instance, the reason why your FHA mortgages, your PMI is so high is because you're essentially financing 96.5% of the house, and over that 80%, it's 16.5%. 16.5% of the loan amount is obviously getting an insurance policy. So they're flexible on the FHA. FHA has a minimum FICO requirement of 620, right? So if your FICO is at least 620, you can document your income. Just in very vanilla terms, you have the opportunity of being able to go for it. But the worse your credit is, the higher that PMI, the higher that insurance payment is, right? The same way if your credit is bad, your car insurance gets rated. The same way all the other insurances you try to get if your credit isn't as good gets rated. So in those instances, that's why people try to dodge the PMI. The problem is if you went conventional, put 5% down, you're still getting hit with PMI. If you go jumbo, jumbo split up 80-10, so you're not going to get any PMI that way. But, between the VA, or I think the VA dodges it too. So between FHA and conventional, obviously you're going to get hit anything over 80%. But the rub to PMIs, there's actually an additional PMI payment that goes towards the payments, the actual payments. It's a small nominal amount every month, but people don't realize it, but it's actually there. So you got to get double hit there. But the perks that come along with an FHA mortgage obviously are significant. So cases, the debt to income's higher related to other mortgage products and such. So, I think the thing that we were kind of going through today was just that I think that there's a gap that goes on because maybe not all the realtors understand.
And it's so important for realtors to be educated in this finance area as well, because a lot of them just go by whatever someone else tells them.
Or just an assumption, right? A misconception maybe that they operate their own lives within, right? So, it becomes a situation that they may have their own personal myths that they believe that applies to credit and things like that, and they just apply it that way. Real good real good agents understand all this stuff, right? For the most part, maybe not as well as I do, but enough to be able to communicate it to the client, right? Some of them just focus strictly on their craft, but I do think, for the sake of simplicity, because again, when we were talking to the client today, not to keep going back to that, but she was not well communicated to, right? And, obviously we like clients to come to us first anyway, especially if we're working on the report before they go out and they go for the finances, so that we can properly communicate it to them. And more importantly, prepare them for whatever expectation they're walking themselves into, right? So they don't get blindsided. In this case, it just wasn't the case. We were on the phone for 45 minutes, kind of going through everything little bit, piece by piece, because the client went and tried to apply before we had discussed it with them, and that wasn't properly explained the different mortgage products and all the different areas of it. So, I think, segueing that into the idea behind doing credit repair towards a mortgage, some of the I'd say a large majority. I mean, you can correct me if I'm wrong, but I would think probably close to 65% of the clients that come through, the objective is to get a house, whether it's the immediate objective or it's a very near-term objective that they're preparing for. So, when we go in and take these negative accounts off the report, there's no other way they're going to see these accounts. I mean, I've heard situations which it completely confuses me, but it happens. I've seen situations where clients have gone into the bank and said, yeah, somebody's working on my credit. The guy at the bank says, oh, well, we'll still be able to see it even if they remove it. And I mean, I literally get business from banks because they know, like, I get clients that they send over to help, and they do so because they don't see it again. I mean, there's no special database they can see. When you're buying a house, the only way, like, for argument's sake, let's just say you had a lien or a judgment of some kind, the only way they'd be able to identify that after it's been removed from the report would be through a title search, especially if it's outstanding. And it happens sometimes. Doesn't happen all the time. Happens sometimes, especially if it's a good title company. Not all title companies catch it. But the reality is that there's no special database. When we move it from the credit report, it's gone. I mean, it's off. It's blocked. And these are the standard bureaus that they use until a new bureau comes out that they start to honor outside of the big three, which I don't see happening anytime ever. When these things come off, they come off. So you're ready to go. So we say, and it's indefinite when we go in and remove these accounts. So it's not as if we say, okay, it's on. I hear this a lot. I'm sure Gizzy, you hear it too.
Yeah.
When these things come off, do they stay off? Yeah, they stay. I don't think we'd be in business this long if they didn't stay off.
Counting 10 years plus. So whatever is removed gets permanently removed. So if you go to a lender and says it's still going to be there, even if it's, credit repair, it's negative. We know what we're doing here. Everything is off. Go ahead.
Yeah. No, I'm just saying that, I mean, given the amount of, there's a high level of expectation for us that goes on in this situation. So if we weren't able to keep these off, I don't know how long we'd be in business. I just don't even know what service would be offered at that point. If you can only do it for a specified period of time and then you come back around and your credit doesn't work again, I don't know how you could charge for that. Knowing that it's not going to stay off. But when it comes off, it stays off. And when it stays off, it allows you the opportunity to go purchase a house and do all the things that you want to do fiscally from a credit perspective. The one thing that needs to be understood, though, which I think sometimes gets confused, is that when we remove these accounts, we remove it from the bureaus. The bureaus are essentially a third-party reporting agency. So, we take these off of the bureaus through loans that they've set up and through a broader process that we utilize to get these removed. These don't, the balances that are owed do not get removed from the balance sheet of that institution, right? Like, we don't go in and hack into the systems of the creditors. It doesn't work like that.
All right.
So, if you charged off an account, or if you foreclosed on with Chase Bank, 4 years ago, 5 years ago, and we removed it, and you go try and get a new mortgage, you go back to Chase, they're still going to see that on there, right? So, the one thing that we do stress to clients is if you've recently charged off a credit card or a loan or something, and, within the last couple of years, and you come through and we help you out, don't go back to that lender right away. It's not, there's enough lenders in this country. There's as many banks now lending money as there's people breathing, pretty much. So, you don't need to go back to the same lenders you went to before, and I certainly wouldn't advise it either if you're deciding to move forward. But, whatever the case, it's a process that we have been doing. I couldn't even tell you how many people we've helped get into houses over the years. But, it's a process that we've done over and over and over again, and it's one we look forward to continue to help people with. Sometimes it's a little easier when we're answering questions about it, so we can give more specifics relating to it. You know what I mean?
Correct. No, but here's the thing, though, which has happened to a lot with some of our customers, where they get mortgage ready, but then a collection account shows up on their credit report, and we're like, why would how does this collection account show up? Do collection companies, do they run people's credit and see that a mortgage company like ran their credit, therefore they're going to add a collection a collection?
Wait, say that last part again. I'm sorry.
Okay. Some customers that we have fixed them and they have been ready to go for a mortgage.
Yeah.
All of a sudden, the collection account, there's a new collection that shows up that prevents them from getting this mortgage that they have to pay. My question is, how do these collection companies find out that this person is gonna go for a mortgage, do they run?
Yeah, I think that's more of a coincidence, quite honestly. But I mean, understand something. So let me give you an example. Like FHA has a threshold of collection amounts up to, I think it's $2,500 that they allow you have in open collections, right? Where they'll essentially they'll go up to that amount and they won't, like it can be outstanding up to that amount. You understand what I mean?
Yeah.
You can go up to $2,500. So if it's like a $50 collection, it's not gonna impede upon the overall ability to close on the house or anything like that. Right now, a conventional mortgage is a little different. Obviously, the higher the amount of the collection, the more problematic it becomes. But as long as it stays under there collectively on the FHA side, it's not going to impede the ability to close. But look, the reality of the situation is it's not just mortgage related. You know, if it's a particular client that has a lot of stuff hanging out there, things come to the surface at the most unopportune times. It's just the way it is. You know, it's just the reality.
Yo, I tell people all the time, light a candle or burn some sage in the house so you could get good energy, because there's some of our customers that have come through, bro. They got the worst luck.
Well, you know what it is? Honestly, I'm a firm believer that everything happens for a reason, right? So, I mean, in situations like that, I feel like probably just wasn't the right time, and the right time will present itself.
Correct.
But the reality and the fact of the matter is just that in those particular instances, the client ends up closing anyway, right? It just doesn't happen right then and there. And whether it's a credit card or a mortgage or personal loan or whatever it is they're trying to obtain, it just doesn't happen in that exact moment. And it probably didn't happen for a particular reason. So the good thing for the client, though, is it gets them in the mentality like, oh, wow, I can close on the house, right? It's just this came up and this happened. And obviously, because we've seen it, it's a very emotional moment. But then they get back there eventually. We get it back off. They get back into the house. And it's a done deal, right? So there is no way, though. There's no way that I'm aware of that a collection company would be able to go in and identify if there's a mortgage application, in order to be able to kind of thrust it. And with the way some of these collection companies operate, the way these debts kind of work their way around, it's very cavalier, right? They come through like thousands at a time. Yes. You know what I mean? Like in some cases, tens of thousands at a time. If you're one of the big ones like Portfolio and Midland, and for them to get that whole file through and work it top to bottom and find out which accounts are legitimate, which ones weren't included in BK, all these other different factors, it takes a long time, right? And you don't have somebody sitting there, one of the big ones going, man, I'm going to get this guy, right? I'm going to wait right until he closes and pop it on there just to screw him. Because the reality of the situation is if the lender pulls your credit January 1, right? And your objective is to close February 1. If they pull it January 1, that's the report they use. They don't need to pull it again unless the approval requests another pull prior to close.
Correct.
So the only time it would become a problem is if the lender requests another pull of the credit report.
30 days or 60 days from that time? And
it's 90. The report's good for 90 days.
90 days.
But from when they pull it. But if for some reason in the condition, when you submit a loan, any of them, what happens is you submit it into the system. It says it's approved, and then you get all these different conditions that come along with it, right?
Correct.
Files that are very clean and neat and everything works have very few conditions. Files that are very hairy and are just barely making it are riddled with conditions. And those conditions are essentially documentation that the bank wants in order to say, yeah, we'll do this loan. Yes, we'll do it as long as we have all this documentation, right? And in some cases, that stipulation is for any number of reasons. Maybe there's an account that needs to be settled or something like that, right?
Correct.
That they want to pull it, a week or so before closing. As one of the conditions that needs to be met along with all the other paperwork. So in those instances, it becomes a problem. In the instances where there's not an issue, then they don't need to pull it again. So it's really specific to the individual. But when that individual does have to have it pulled again and something's on there, it's a
But the person can't, in those 90 days that you are mortgage ready, you can't dispute that new collection that you get. Is that right?
Wait, say that. I'm sorry. Say it again. There's an email that just came over from I think a listener. But go ahead. I'll read it after you say that. Go ahead.
Yeah. In the 90 days, we'll get this person mortgage ready. They're in the process, and then boom, they get a collection. That collection, we can't dispute it because they're in the mortgage process, and you can't be in dispute during the process. Is that correct?
Right, unless there needs to be some kind of resolution and they need to pull again, whereas you have that opportunity. Understand what I mean? So typically speaking, like let's just say we finish a client up and we send them off, which happens a lot. You know, go get your mortgage. The one thing that we have to do is make sure that there's no dispute notations or no accounts in dispute. Because if you do, then one of the stipulations from the lender will be, yeah, your approval, we got to repull credit again because no accounts can be in dispute. Because they know that it kind of jiggles the scoring, right? In some cases, it can give you a couple extra points. In some cases, it can dock a point. It doesn't give you a true scoring barometer. So what they want is they don't want all the disputes and any notations removed, so that when you submit to them and you go into underwriting, there's no confusion about where your score sits properly at that time. That's why I always tell clients, listen, we have to stop. If you're going to go for the mortgage before we finish, we need to stop disputing, and then after you close, we can pick back up again. And they're the reason. So if something were to show up in the middle, and the objective wasn't to pay it off, just to close it, right? Not necessarily remove it, but close it if it's not impacting the score greatly. Then obviously that would be the path of least resistance, right? Because the disputes themselves take a couple of weeks. But if it's a situation where it drops the score so significantly that they need to redispute it, then they have no choice. You know what I mean?
Correct.
They just don't have a choice because they got to get back up above that scoring threshold. Now, there was an email that came over that said, and I'm pretty sure somebody that's listening right now that said that have we ever removed a federal student loan before the account's open and has 100% payment issue? But the reason I want to remove it is because it's killing the debt to income. So
I got a text message today about that. I don't know. It's probably the same person.
Yeah. So the answer to that question is we remove student loans all the time.
Correct. Student loans can be removed, my people. So if you have student loans,
we remove them all the time. But again, to repeat, it does not mean you don't owe the money to the Department of Education.
Correct.
Okay? You still owe the money to the Department of Education, and that is one debt that will follow you around for the rest of your life. It's not statute related like all the other debts. They're similar to the IRS, where you owe them money. You might as well get used to the fact that you're going to pay them at some point in time. So, can we remove them? Yes, we remove them all the time. The other thing I hear a lot, I know this is a little off topic, but I wanted to address it. It just came over. The other thing that we hear a lot is, when you're moving to you stay off? Yeah, I mean, I don't understand the whole, because there was a client that reached out not that long ago and said, I know you guys remove student loans. Do they stay off? Because I've talked to a lot of people and they say they get them off, but they don't stay off. And I don't understand. It's beyond me how people can remove things and then they don't stay off. I don't know what happens. You know what I mean? Like, that's something that just that escapes me, how it comes off. Or my question is if it even really comes off. You understand what I mean? Like, I think that I think what's ended up happening when people say stuff like that is they just put it in dispute and they get them set up with some site where it masks it and the score goes up, like Credit Karma or something. You know what I mean?
Correct.
Where it gives you points while it's in dispute, and then when it comes out of dispute, it goes back. So I can't help but think that's where that's coming from, because it doesn't make sense otherwise. Because the way the algorithm's set up with these bureaus, it doesn't work like that. Things just pop and remove, pop and come back on. You know what I mean? Like, unless there's something that's causing it to pop back on. So to answer the original question without going on a tangent, we remove federal loans. We remove all student loans, whether they're public or private. We move them all the time. And, as far as the debt to income, I mean, these student loans are a big problem for a lot of people as far as impacting debt to income. Even if you get, let's just say in this instance, the balance is $50,000, right? Where the typical payment on $50,000 is like, I don't know, might be like $700, right?
Yeah.
But the thing is that if this particular individual were to go and do like an income-based or an income-sensitive repayment program, which the Department of Education offers all the time, if it's tight on income, and you get your payment knocked down to like, which we see all the time, and we've helped clients do it all the time, you get it knocked down to like $5, $6, $7 a month.
Correct.
And keep in mind, this is $5, $6, $7 a month that pays as agreed with the lender, and that's all you have to pay each month to service $50,000 in debt. This really happens. But with that being said, when a mortgage company goes to do the arithmetic on it, they use the actual payment, not the modified payment, the actual payment. So even if you're paying $5 a month for this $50,000 loan, when you go into underwriting for a mortgage, they won't use that $5 a month number, because every year you have to renew it. So they use the real amount, which is $700. I know I think a lot of people don't understand that.
No.
They think that whatever you're paying is actually what ends up getting correlated on your debt to income, and it's not the case. So
that's why these people that have high student loans, that's why they can't get any mortgages.
Oh, I mean, I have, you know, I mean, look, $150,000 loan, the payment's almost $2,000. You know, I mean, $2,000 is a mortgage payment, and that's a $400,000, $500,000 mortgage payment by itself.
Yes.
You know, and that's $150,000 in school loan. The average school these days is like $50,000 a year. So, I mean, not only now, but imagine what's going to go on going forward. I mean, they're going to have to make some kind of an adjustment.
Yes.
Because otherwise there's going to be, I mean, granted, things are turning over and continuing to turn now, and they're making it work. But the reality is, I don't know how it's going to be sustainable, because you're coming into a new generation of kids that are going to be saddled with more debt than the last and more debt than the pre. You know what I mean?
Yes.
Every year it gets more, because every year the cost of the tuition continues to go up way ahead of inflation, right? Way ahead of any kind of inflation indicator or anything close to that. So, you know, with that being said, I think it's important for people to realize that, you know, if they do have school loans and they did get fortunate enough to get on one of these modified programs, though, that from the mortgage perspective, though, they need to realize that it's going to be based on what the original payment was. So that,
but at least they could get the student loan removed. They could get on one of these payment plans. When the mortgage company runs the credit, they're not gonna see the student loans, so it doesn't go into their debt to income. So you have more borrowing power.
No, but this is the tactical way of doing things, right? This is why we always tell clients, you know, when you come to us, we're not just coming there to get your scores into the 700s, right? Correct. It's to position you into a situation so that you can actually achieve the goal. Right. I mean, we're not telling you not to pay your school loan debt. We're not telling you not to pay bills. That's not how we operate. That's not the situation. Correct. We're trying to get you in a position to where your credit report can facilitate it, and you can do it at a prime rate that's sustainable for whatever kind of financing you're trying to get. Right. In this case, we're talking about mortgages, which obviously for most people in this country is the biggest purchase that they're ever going to make. Right. Correct. And in some cases can be the most important purchase they're ever going to make.
Yes.
So it's important, if you're going to go for it and you're going to take that leap, that you need to be aligned with the right people, especially if you're somebody that has credit errors, right?
But also, there's so many people that we talk to who make over $100,000 a year. All right, and these people, and they don't know.
Listen, I've helped all kinds of demographics from, you know, one of my clients still to this day recently was a Fortune 500 CEO, okay? And all of them, it's the same level of understanding of finance, right? You're not taught it in school. You learn on the run. Can you imagine trying to learn math on the run? Can you imagine trying to learn science on the run? And
well,
it from...
we have our customer Omar, and he's learning it on the run with trying to get that big mortgage.
Right, but I mean, there's a lot more to that story, though.
There's a lot more to that story, but you don't want to get put in a situation where you got to learn as you are right there, especially when you're coming out of pocket, you know, $40,000. You know, it's better to get educated first and then go about learning about how to get.
But it's not only that, though. Understand something, though. You know, you're dealing in a situation where he'll get a crash course for that particular instance, right?
Yes.
But if you're not surrounded by the right people, they're basically sitting in that situation saying, man, it got done. And they're like holding their breath. It shouldn't be like that. I mean, it's a process. It's very clearly defined. Understand what I mean?
Correct.
Like when you walk in for the mortgage, most of these mortgages, whether they're FHA, conventional, if they're standard, they're getting sold to Fannie or Freddie, right? Fannie Mae or Freddie Mac. They package up, you know, all the big banks, they package up these loans and they sell them in tranches to Fannie Mae and Freddie Mac to get their liquidity back, right? So they all need to fit into certain guidelines. There's not that much of a deviation. There's actually zero deviation between you walking into Wells Fargo and you walking into Citibank to get an FHA loan, right?
Correct.
There's zero deviation, or going to Quicken. There's no deviation. It's the same product. It's just the people you're dealing with that's going to differentiate, because in essence, they're just going to package it up and they're going to sell it. They're going to turn around and sell it to Fannie, who's going to be the ultimate mortgage holder for your note for the next 29 or 30 years, right?
Correct.
That's just how it is. I mean, so there's not that much confusion around how you get there. It's just, if you're like an Omar situation that you're referring, our client Omar, you know, if you're in a situation where the people that are kind of steering you may not have full control of the car that they're trying to steer you on, or maybe there's some special nuances that go on in his situation. we didn't really get introduced to what he was doing until he was like a week away from settlement, and the settlement didn't happen. So
until he was honest with us.
Right. And but the reality of the situation is, if he would have come to us first, much like the client today, where we were able to kind of get her in the right frame of mind and understand everything that was going on.
And by the way, this customer is a truck driver. Okay, a lot of our customers are truck drivers, but they differentiate from all types of people. But there is a percentage that are strictly truck drivers. But go ahead, Jay.
Yeah, no, it just in those instances though, it's really important to just kind of make sure that everything's dotted and crossed, because I mean, it's like anything though, I mean, when you're coming, it's a process. Like we say it all the time, but it really is. I mean, it's a process to get the credit clean. Then it's a process to go through the mortgage. But if you position with the right people that understand all aspects of it, it obviously makes it a lot easier, because it takes the guesswork out for you and the indecision. Like our particular client Omar is feeling over and over and over again. It's just a constant indecision. You can walk into these situations completely prepared, and that's what we're capable of doing over and above the credit stuff. I mean, I think that the credit stuff is stuff that comes to us naturally because we've been doing it so long, right? And as long as the client's patient, we can get them in that position. The thing we're trying to impress upon clients, not because we want them to put the mortgages through us or through the people that we utilize, it's because of the fact that we want them to achieve the goal. You understand what I mean?
Correct.
Like without the nonsense, because the nonsense can be avoided.
Correct.
Right. And everybody will sell you everything. It's the job of, we always, we've talked about this before. It's a show and prove environment. And I think, 10 years doing this with 10,000 clients, I think it's safe to say we've shown and proved. But obviously it's always a show and prove on a daily basis. We'll continue to show and prove. But I think if it would be wise for clients, if you are considering going for the mortgage and you do have credit issues and you're trying to figure out where to kind of align yourself with, I think aligning yourself on the credit side with people that can kind of prepare you for that second and third and fourth step, I think is important.
So I have a question from someone on Facebook. Just hold the thought right there. What about adding trade lines to help boost credit profile?
To get to a position where your score meets the requirement? Is that the question?
Yes.
Okay. So it's not a terrible idea. The problem though is that you need to have a certain amount of primary accounts. Like you go FHA, I think you have to have at least 3 primary accounts that they require, and those accounts have to have a certain amount of seasoning. So you still have to have at least 3 open primary accounts that are active and operating, right?
Do these accounts need to be in some type of limit?
No, there's no specific type of limit. Believe it or not, they could just be Capital One cards or First Premier cards. They just need to have some age to them, right? That you can't just open them a week before you apply for the mortgage. The bank has certain requirements. Again, it goes back to what I was saying earlier about the fact that all these things are very, very, very boxed in, right? There's not a lot of deviation among these. That's why there shouldn't be that much guesswork. But going back to the original question, yes, it can work as long as you don't have collections that exceed 2,500. You don't exceed, and again, I'm talking right now, I'm speaking strictly FHA. If you don't have collections that exceed 2,500, because in that instance, then you'd have to come out of pocket or work that out or get that removed, because that's an account that's going to have to get handled one way or the other before they'll allow you to close, right? As far as outstanding balances, if you're just somebody that may have a late payment here or there and it's not within the last 18 months, or if it's only one that's in the last 18 months, you provide a letter of explanation and the AU will get you over. I think it's smart. I think it's wise. And if you don't have the liquidity to get your ratios down yourself, to get your ratios, your open unsecured credit ratios down, then yeah, the AU is the only other way to feather that out. And that would be the way to do it. But kind of the nuances to that would be what are the credit account issues that you're kind of superseding with that AU, and are they recent, or is the collection balance too high where it could impede, either you having to come out of pocket incredibly or the overall approval because the lates are too recent. So yes, the general answer to that would be yes, but on a specific basis, I'd have to probably look at it. But yeah, it can definitely help though if you're close. Now on the conventional route, not FHA, where there's a lax FICO requirement. On the conventional route, you're dealing in a situation where you can't really have any hair on the file. Everything needs to be cleaned. can't really have much deviation. I think the cutoff is typically around 680, 700, closer to 700. So if you have leads and stuff, you don't really get that much of a flex on that. It has to be taken care of. And then here too, there's no threshold for or flexibility for collections on the conventional side. So you really only probably be able to get away with that on the FHA side. Otherwise, it would probably not help as much on the conventional side, but definitely on the FHA side, which again represents most of the people coming in and buying these days. That's why they do it.
Okay, we got about 22 people on live streaming on YouTube, and we have a question, a couple of questions. What is your success rate with fixing credit profile? How long, if you can give me a rough estimate? By Magic Matrix, that's his name.
Well, I don't know what's Magic. I'm not familiar with that term. What does that mean, Magic Matrix?
No. That's his name. That's his name on YouTube.
I'm sorry.
Yeah.
Okay. What was it? Say it again. I got lost in Magic Matrix. What is the success rate? I would say, I don't know if this particular individual has been following some of these recent podcasts we have, but what we typically tell people when they come in is it's not if, it's when. If you let us finish, we'll get you there. So, I mean, we don't necessarily keep like a success rate of, because we're goal driven. Getting the scores up is not the problem. It's more the individual being patient. And as time has come on, as time has gone on over the course of the last 5 or 6 years, you know, a lot of like the fly-by-nighters will get it done in 15 minutes for you have kind of subsided. So now what's for the majority, the people that do real volume in this business now, what's left is people for the most part that know what they're doing and are able to get you from point A to B. I'm not saying all of them. I'm just saying there's a lot less, you know, goofballs out there than there may be bad actors now than there was before. And with that being said, we typically tell people on average, allow us 2 to 3 disputes to get you where you need to be. Okay. Right. Like the client we had that we did, Dante, that we did the live cast with on, I believe it was Tuesday last week.
Correct.
You know, he was 2 disputes and he closed on his house in 3 months. He literally closed in a month after we got 2 disputes through, got him ready for the mortgage. Now we're finishing up any little odds and ends. You know, some clients take a little bit longer. Some people get done shorter. Most people fall right smack dab in the middle, and it'd be impossible without reviewing the file and all the tangibles around it to give you a specific time. But we try to give like averages based around the mean, you know, the general average of what it typically takes for us to get the file in the position to do what it needs to do. And typically that's 2 to 3 months. Sometimes it can be quicker. Sometimes it takes longer. What we like to tell people is the one constant is we work until we're done. And then with that being said, every client that we start, we do an intake call with after we submit.
Correct.
And on those intake calls, not only we go over the process, we discuss, you know, we try to set some sort of light expectation because it is still credit repair. But we also we go through the goals of the client so that we know as we get them in that position. See, we don't necessarily always wait until the file's 100% done to start knocking goals out. If a client needs a car and they need it yesterday and we clean Equifax first, we'll start pumping them through Equifax lenders. We'll get them a prime rate auto loan 2% through an Equifax lender while we're still wrapping up the other 2. They're happy like crazy because they just got the car, which was their goal that they needed yesterday. They get it taken care of while we work through the other 2, and the pressure's off them now, right?
Correct.
And we can work
That's
through
what
it.
credit repair is right there. You go goal by goal, because many of our customers, people who follow me on Facebook, YouTube, they start off with just wanting a car. Then next thing you know, they're looking 2-3 months after they get the vehicle from an Equifax only lender that we cleaned off. They start thinking, can I get credit cards? And then they start thinking, can I eventually get a mortgage? That's what happened to.
I think what ends up happening is, I think, and this is part of the reason why we're trying to provide a lot more transparency around this process is that, you know, it's kind of a touch and go. You know, even though we've been doing this so long, you know, I had so many clients, you know, it's understandable that a client coming through YouTube or coming through Facebook would be tentative, right? Because they see all these other videos that may be nonsense, or maybe just be smoke. So when they do get started, there's an early stage level of somewhat of skepticism, right? Where they're still not 100% sure it's going to work, but they're confident because they've seen all this other stuff, right? Correct. So then when you show them in a short period of time, wow, this happened, wow, that happened, then their mind starts opening up to the idea, okay, well, I just got a car, you know, and they were able to do that for me. Maybe they can give me some funding. Okay. Even though it's kind of reversed because you should do the house first. But the reality is it ends up, in a lot of cases, it ends up being like their eyes start opening very, very slowly to what the process can actually do. And then walk it like we talk it, right? And it becomes a situation where we tell you and we go through all these necessary measures, obviously then still confidence and keep transparency. So it's a completely transparent and open environment, but at the same time it's to knock out goals.
Well, like the customer that just the first customer who commented on the Facebook live stream was John Alexander from Rhode Island.
I remember John Alexander. John Alexander.
You know what he said? You know what he said? He said everything was removed. I said, bro, we know that everything was going to be removed, but again, he's a great example of a person who started. We helped him, all right, but then he wasn't updating his credit reports. We were unable to do our job to our best of our ability.
No. Here's what happened with John. I don't want to, I don't want to call him out.
We don't want to go over the subject. We're talking about mortgages, but if you want to go into John,
but no. Here's what happened. It was great though. It's all for the positive because he came through. We got him within, I think it was 4 months to get his house, right? He bought his house. He was very happy. Then he came back. We kept working on it. I think he got a second house. I think it was maybe an investment property. Correct me if I'm wrong. And then
yes, correct. Investment property.
Yeah, and then he opened up some lines. He got his car. Everything he got together. So then he started being a little bit lax about updating when we asked and letting us finish up. And then when he needed it, he came back around. And started updating. We finished up a little odd and then was there and we took care of it. That's what I'm saying. Like, this is about, for us, it's more about just making sure we can get you A, to your goals, but B, also finish what we start. And if you let us, we will. Even in a situation like that, right? Even in a situation like that, it becomes a situation where, the client had kind of achieved a lot of his goals up to that point. And then, everything settled and he came back after a period of time when a lot of those goals were hit and he needed to revisit it because he needed, for any number of reasons, he needed his score jumped up. And that one account that was left there on, I think, 1 or 2 bureaus, we knocked it off and he was good to go. So it's one example of a much larger, and again, it ends with a success story because I only bought a few houses, right? I mean, I a few houses, opened up a bunch of lines and everything like that. So every goal I think he originally intended to achieve, as far as we discussed, and I think he started coming up with goals after we started. It's my understanding.
Well, he had filed for bankruptcy, so we were able to remove his bankruptcy. I believe the bankruptcy on Experian was the last one to remove. But he just commented that, thank you so much. Everything was done. So it's always good to hear from him.
Yeah, absolutely.
I got another question right now from Star, one of the real estate investing people that I know. So she goes, so you can pinpoint what to correct first on the credit report file, meaning what will be the most beneficial to one's needs.
Well, I mean, if she's asking if we're able to go in and find out which account's going to hold more like score related weight than another.
Correct.
I mean, we don't try and break it down to that extent. I mean, when we go in,
it's to remove everything.
We go in with the objective to, and there's constantly clients that come through and say, well, can you move this one account? Because I'm sure this is going to get me the 40 points I need. And number one, no, it's not. Number two, there's no way to do that. I've worked on so many files, and given all the amount of formulas that there are out there, even there's so many deviations of just the FICO-based formula, it would be very difficult for me to say one account's going to represent 22.5 points, right? It's impossible. So the only way to do it right is just to knock them all out, right?
All right.
And as you're working through it, the dust will settle where the scores will settle, right? So, for instance, if you have 10 negative accounts on each bureau in the first round, we knock out 6, your score jumps 65 points. Well, that might have put you into the position to go get the mortgage. If you want to get the mortgage now, you knock it out. Then we come back and we take the rest off. But trying to individualize and say, can you remove 3 out of the 9 on here? Number one, that's not what we're about, though. I mean, that's like having a plumbing leak in the entire house and only fixing the problem in the master bedroom, right? And then letting all the other stuff leak out. You're not fixing the larger problem. You're putting a Band-Aid on one area and you're ignoring the rest of the issues. And that's not going to get you any better. Again, I keep going back to the fact that our objective is to make this a sustainable process for people, right? Sustainable meaning you leave us and you are now in a position to move forward and sustain it going forward. Not a situation where you go and we give you a 750 credit score and you go to the dealership and the dealership takes advantage of you, gives you a car loan for 15% on a $50,000 car that you're not going to be able to sustain for 3 months, right? Then you're going to be right back on our lap.
Correct.
So, I mean, the overall...
Which many people who have come, some of them, that's what's happened.
Well, in the past.
In the past.
Right? Going in the early years of doing this, before we really started to really kind of show, and it was out of necessity, right? Like, we were having clients who were doing this, right? And we're having clients who were getting their credit cleaned, and then they were going and they were ultimately getting taken advantage of in dealerships, and they were getting rated at certain areas just because they maybe didn't know. So we said, you know what, this is just getting outlandish. So, because it's a lot of hard work to get the client file to where it needs to be, to turn around and have some dirtbag try and take advantage of the client because they maybe don't necessarily understand that aspect of it, and they're taking advantage of that in a predatory fashion. It was just too much. So we started to incorporate helping with the mortgages, and then the funding, and then the auto loans, and then all the other stuff. And now we obviously help. We get the school loan straightened out if the clients need it. We can help with tax issues. Again, just in a way so that the client gets it done, which is important, right?
Correct.
But B, making sure that it's done in a way and in a professional way so that it's sustainable for them going forward. So to answer, without digressing too far, to answer a question, we don't pick and choose. It would be way too difficult. And these disputes themselves, they take a month roughly to, depending on how many negatives are on there, roughly 3.5 weeks to get back in the first place. So if we turned around and we were to just venture a guess, which we would never do anyway, but if we were and it ended up being wrong, we would waste a whole month of the process, which is a lot. And it's just, there's just not that kind of flex in the overall process. So I hope I answered it.
No, you did. I actually have another question from Brian Taylor. That was a Facebook question. This is a YouTube question. Brian, as you know, he does credit repair, but he has a question now. I have a question. I keep having issues collecting monthly payments. How do I or can I collect up front? Because I heard if I collect up front, they will close my business down.
Okay, so there are certain states that you originate in. It's become a good amount of them now, where as long as you get credit services organization bond and you're bonded with a national bond, like for instance ours is with Hartford. It enables you the right to be able to take payments in advance. There's a process to it in the back, where it's got to come in and get filtered through the actual trust account and the bond and everything like that. But it's, that's the way that you can do it. And obviously it preempts because, in all fairness, like we were talking about a podcast or two ago, we've tried every possible payment scenario over the years with clients to try and acquiesce, right? To try and be fair, and try to cater to everybody, right? And do our best. And the reality of the situation is, this is the best and only way to do it. Only because, for a multitude of reasons. One, when a client is, I know the psychology of the client because I've been doing this for so long. When the client's paying $100 a month or whatever you're trying to hit them off with, and if it takes long, which you can't control as the service provider, right? I mean, you can, but you really can't. If it takes too long, they think you're gouging them and they get angry, right?
Oh yeah.
And then it becomes that kind of an argument every single month. You're trying to get money out of, right?
Nowadays, it usually happens 6 to 9 months. They're like they're hating on that company.
Yeah, that's what I'm saying. It's because they're hating because they keep paying. You understand what I mean? So the way we try to do half and half, which on certain occasions we still offer, but the problem we're having with a half and half to split out the exposure, right? You're not going, I'm not too far in front of you, you're not too far in front of me, split half and half. Problem is, we were finishing people's files. They were going to buy houses and they were waiting to pay us. Right? They were going to settle on a house, and we're arguing with them about paying the balance. Like, you wouldn't even be in the position to get the house. It wasn't hers. Why do we have to wait 30 days for you to pay us? It's not okay. So, in this particular situation, through a unnecessary amount of trial and error, we arrived at the fact that we price it now to a point where we expect to get it done. The formula we use, we expect to get it done in a certain period of time. If it goes longer, it's on us. If it gets done quicker, we make more money on that formula. But the reality is that, there's some files for us where a client pays. I mean, and this is just the brass tacks. If somebody, let's just say there's a client that's been and it happens, 10, 15 different companies. And in that period of time, they've had every single person lay hands on that file, right? And they've tried every single method you could possibly imagine most of them nefarious, and then it lands on our lap, and it's like, and we quote it as if it's like, let's just say there's 2 accounts left, right? And we quoted a very generous price because we don't ever get told the whole backstory when it comes to us. We just find out after we work on it, and in doing so, that generous price, because it ultimately is going to take us longer. So we end up taking a hit on that if it takes us, let's just say it's 2 accounts and ends up taking us 6 months.
Yeah.
That's we take a hit on that, right? Because we continue to work on it until we're done. So to answer Brian's question, first part, if you do the research, it's state specific though. Like, in Florida where my office is, it's if you go to the Attorney General's office, it lists all the requirements, one of them being the credit services organization bond, the trust account, et cetera, that you can set up in order to be able to accept upfront payments. A bond is essentially an insurance policy that protects you, meaning you as the consumer, right? If anything were to happen, that's essentially, it's just like when you're driving, having car insurance. If somebody hits you, you're not coming out of their pocket, right? You're basically going after the insurance company. In these instances, the bonds are a little bit different, but it's the same idea. That's insurance policy to protect the consumer. That's why they allow the upfront payment. Unfortunately, on the payment terms and collecting, there's nothing that I can say to you, because the reality of the situation is this is just the psychology of the consumer, right?
Correct.
And I mean, it can be sympathized with, right? Because it goes back to the idea is you just don't know who you can trust, right? Unfortunately, and that's why we're going out of our way right now to try and continue as time goes on and as this stuff goes on, trying to just be as transparent as possible. The client knows walking in, they can trust us. And it's everybody establishes trust in a different way.
Correct.
But they have different issues with trust. So to answer your question, unfortunately, I can't help you on the payment side of things. I apologize.
Yeah. All right. So, Brian, you already know, you can always email me. You've been one of the first people to purchase our professional do-it-yourself credit repair systems. You're still out there helping people, doing something honorable for people, which is great. The only thing is that, you're going to have some people that you're going to help that, they're not going to have their best intentions in themselves. So they got to help themselves out in order for them to get help. All right. So I have another question for Margarita. She says, this is on YouTube. Gizzy, if I have a mortgage now and we improve our credit, would we be able to refinance our mortgage to a better interest rate?
Without a doubt, yeah. So if I understood it correctly, so she has a mortgage right now, primary mortgage, or even if it's like an investment property, it's really irrelevant, but she's rated at a certain rate, assuming rates have dropped since she took out the mortgage, which, I mean, rates have dropped over the last year. So assuming that they've dropped, then without a doubt, assuming nothing's changed with the dynamic, you know what I mean? Like,
but how long does she have to wait, John, in order to get a refinance? So
if you purchased, typically speaking, on a conventional side, the seasoning is 6 months. So if you bought it in, what's 6 months from now? So
it'll be June, July, June.
If you bought it at the beginning of June, you'd be able to qualify to refinance it now. Typically, if you don't do any, if you're trying to get any kind of, it's typically 6 months from the date that you close on it. If you somehow do improvements or something to it and you can substantiate it, normally they'll let you refinance it sooner and get some cash out. But if it's just a general scenario where there's been no improvements, just trying to drop rate and term and stuff, it's typically 6 months as a seasoning. You got to have it in order to be able to do it. Plus, honestly, you need to have equity in there to be able to do it.
Correct.
So if you bought the property for what it's worth, and obviously 6 months of payments are going to be very little towards any principal in those particular situations, we're only going to lend up to 90 in a FHA scenario, 96.5%. So you have to make sure you're under that threshold, right, in order to be able to refi just a rate and term scenario. But in theory, yes, typically you can do it after 6 months after you purchase. If you've owned it for a while, and your rate's a little higher and you want to get the rate down after the credit's improved, without a doubt, you can refinance. No question.
No question.
Okay,
I have another question from Curtis Davis. Great show, he says. Know the difference between FHA and conventional? Do you cover the topic? Sorry.
I'm sorry, maybe I misunderstood.
He's asking. He's saying that it's a great show that we have, and he says, "No, did you cover the difference between FHA and conventional mortgage?"
I broadly did, but I don't mind going into detail. So FHA is basically the idea that it originally started as a first-time home buyer program, right? So
well, he also goes into PMI. Did you talk about PMI? So
we did, but I can circle back to it. So I can without saying the same exact thing. I really didn't go into this detail before as far as the FHA, but FHA was originally the first-time home buyer program before the economy collapsed in 2008. It was only for first-time home buyers. It would only apply to them, right? And then after the economy collapsed in 2008, they changed a lot of lending guidelines, one of them being that anybody, as long as it's your primary residence, you can go FHA. FHA is essentially a government-subsidized program, meaning if there's any default on it, the government will come in and insure those losses for the bank, which in essence, they'll basically cover it. So that's why the banks push it a lot. That's why you see it a lot, because it's essentially risk-free lending for them between the insurance policy on the PMI on the back side of it, which we talked about earlier, and the fact that the government's going to cover a large majority of the principal on the front end. That's the difference. So for the lending entity, it's very, very risk-friendly, right?
Correct.
A conventional loan is essentially just the bank lending off the balance sheet, right? So that's why you're seeing a little bit of a less, or they want a little bit of more money down. There's not as much PMI around the payment, but you still need PMI that anything's over 80% that they're going to require. So the limits on FHA, the loan limits are typically county specific. Okay, so it's based upon a multiplier and cost of living scenarios. So when you go FHA, it's constrained by a limit. So in your particular county, if you want to know how much FHA will go up to, you can just Google FHA, whatever your county is, county limit, and it'll bring up for one family, two family, etc. Now, sometimes in areas like Los Angeles, most parts of California, and Manhattan, those FHA limits are high, right?
Yes.
They're very, very significantly high. But you go in the average parts of the country, they keep it still relative to a first-time home buyer amount, right? So that's another key constraint that you have on the FHA side. There's still a lot, though. Don't misunderstand me. A lot of counties go up to 450. It equates and it evens out with the cost of living in that particular area. So it's not like if the predominant house in that area sells for $400,000, the FHA limit is going to be $250. You know what I mean?
Yes.
It's going to stick with the predominant area value. But if you're expecting to go higher and get those same terms of 3.5% down, etc., you're not going to get that on the FHA side. That's where conventional kicks in. The underwriting, the conventional is more stringent. The debt to incomes normally aren't as flexed as they would be on the FHA side. But it does go up to, again, starting 2020, it'll go up to $510,000, which again, over the last 4 years, maybe that's gone up about almost 10%, which is significant.
Correct.
So obviously it's largely indicative probably of the values that have gone up over that period of time and just trying to stay ahead of, the market, but probably not too much. So I hope, the PMI, again, without exactly saying what it did earlier, typically speak on the FHA side or in any loan. And PMI is required for any loan that's financed over 80%. So if you finance a loan for 82% loan to value, that 2% is going to get an insurance policy. It's going to be small, but it's going to get it. If obviously when you go FHA and you're financing 96.5%, that 16.5% is getting an insurance policy. Essentially what happens is if you default on that loan, that insurance policy kicks in and pays the bank, which is why I was saying on the FHA side, between the government subsidizing the first mortgage and you having an insurance policy on the difference between the 80% and the 96.5%, I mean, it's as risk-friendly lending as you could possibly imagine. On the FHA side, though, there is a PMI kicker that goes into your payment as well. It's small, it's nominal, but it's an additional cost that goes into the payment. It bumps it up a little bit. On the conventional side, the PMI is isolated strictly to anything over 80%.
Okay.
So it ends up being just over the 80% amount, whatever that amount is that you finance over 80%, you will still have to get PMI on, unless you figure out a way to pay the PMI in full, the premium at the table. But most people choose to finance it because if it's a large loan amount, that PMI amount is going to be high because, again, it's an insurance policy.
Okay, because he also says because people keep saying 580 minimum score, true or not? And this is for FHA.
No, FHA, no. VA, yes.
VA.
VA is 580. FHA is 620. Now again, there's certain situations both in VA and FHA where they can give exceptions, where you might be able to be down to a 612 on FHA or 572 on it. It's not always right on that number if they're willing to give you an exception because other things are good pertaining to that individual situation. But no, VA is the 580. FHA is the 620. If there's no overlays, meaning if you're direct with the lender. If you're at a broker, unfortunately, if there's still such a thing, if you go to a mortgage broker, that FHA minimum might be a little higher, but I don't think there's many brokers out there anymore. The further you get away from Wall Street, the more those overlays are more unnecessary conditions that they add on top because they don't trust the brokers the further you go out. So the closer you are to Wall Street, the closer the terms are going to be that get sold to Wall Street, right?
Correct.
Meaning when they get packaged with the loans. So if you're with a direct lender that essentially is going to fund the loan and then turn around and package it and sell the loan directly to Wall Street, those are the terms you would see, which would be, like I said, the 620 FICO on FHA and the 580 on VA. But that VA number is fixed. I mean, that's always been like that. So
yeah, it's always been like that, Curtis.
Yeah.
Okay, I got another question from Talithia. She's asking, is it harder to remove off one or another when it comes to student loans? I do have to remove from one of the credit bureaus and the other is not coming off. What else can I do?
So, correct me if I'm wrong. She said she's gotten it removed from two, and the third one it hasn't come off. Is that what she said?
Yeah. She says, to student loans, I do have two removed from one of the credit bureaus, and the other is not coming off. What else can I do?
Okay, so she removed two from one bureau, and it hasn't been removed from the other two yet.
Correct.
I mean, again, this kind of goes back to what we've been touching on. Unfortunately, I don't know how it's been disputed. Correct. I mean, it needs to be properly disputed to be removed. Obviously, it's come off one. It can be removed from the others because anything can be removed. In all reality, it just doesn't seem like however it was being approached is being done properly. And I don't know how long it's been disputed. I don't know the ways it's been disputed. As far as what she can do, the obvious answer that comes up to me is let us work on it. The subtle answer would be just, whoever you're going to have work on it next, if you're going to have somebody work on it and you're not doing it yourself, the subtle answer would be just make sure with whoever you position yourself with that they are good at removing these, because it's becoming obvious to me that not everybody in this business is built the same, and a lot of people don't know how to remove student loans. I don't know why. I don't know what they're doing to get accounts removed, but it doesn't seem like that's in most people's repertoire. So I would just make sure whoever you choose to deal with that they that they're seasoned at that art. Not that it should be any different than removing any other accounts, but if
look, she has Lexington Law.
Okay, well there you go. I'm not here to talk bad about anybody. So
we never talk. We never talk bad about anyone. Okay. No, but that company.
I'm not gonna start with them. But I'm just saying that again. It's all I can say is that there's
talk about milk in the process.
I'm gonna say kindly and just say we get a lot of roll off business from them.
Look, people who come to us have been with that company 6 to 9 months. Then they start with us. Okay, and
we're stuck working behind a lot of stuff.
And then we're stuck. Again,
look, I'm sure that they've helped hundreds of thousands of people. So I'm not gonna say that. I'm just saying that.
Correct.
That if you stay with them another 6 or 9 months, I'm sure that maybe it'll come off there. I don't know. I don't work with any. I don't know anybody that works over there. I'm not familiar with them. So unfortunately, I can't speak on even how they really dispute. I just know that we come behind a lot of them.
Correct.
And it's not to dump on anyone, but it's not the easiest thing to come behind.
It's not the easiest things for us. And you know what's not the easiest? It's not the credit report is not the easiest. It's actually dealing with the customer and their emotional attachment that they have to getting the account removed. All right. So we could definitely remove
it. Meaning that there's like a level of frustration that they feel by the time they get to us. Yeah, yes. No, you're right. I mean, it's absolutely right. Because they see the rub with Lexington Law, not to go on a tangent, it's just that they're a household name, right? So in essence, people go to them first. It's like putting your toe in the water. I don't think anybody goes there with the objective I could be wrong, but again, I understand this consumer pretty well. I don't think any of them go into it with the idea that they're expecting to get done. I think they go into it with the idea that it's a household name. They can get their feet wet a little bit. They can get comfortable and see that it's a reality. It may work, it may not. And then it just comes monotony. It's like, okay, they actually dispute. Okay, maybe they get one thing off. Okay, maybe they get two things off. So then it's just a slow crawl, right? And then by 6 months, after they've completely bought in and they realize that in the roll off that we've got, that it's not where they want it to be, but they're still getting charged. They leave there extremely frustrated. And then
you know what she's saying? I've been with them for almost 2 years.
Oh wow!
So $100 a month for 2 years, that's $2,400.
So Brian Taylor, now you understand why we price the way we price, right?
Brian Taylor.
If going back to what we were talking about earlier, I mean, if we were to do that, I mean, I wouldn't even in good conscience feel okay doing that. But the reality of the situation is that there's just no way. I mean, good for her that she lasted 2 years paying $100 a month with the perseverance to try and get it off. But, the way we price is we price. So if it takes longer, that's on us. That's our responsibility at that point.
We only charge a one-time fee.
Yeah, and the fee is on us if for some reason it takes a little bit longer or significantly longer.
Or she could do it herself, you think?
Again, it's to each his own, right? But I mean, if somebody's going to go and buy one of the credit life systems or something like that, it's important to make sure that you actually utilize the support. It's important that you actually read the system. We constantly, we've had a lot of success with the systems. I'm very grateful for it, right? But the people that come and they're like, they'll email the support, whether it's on the form or the team, and they'll say, I don't have all the accounts off. It's taken too long to get done. I've removed 80% of it. Why isn't 100% removed? We'll say send over your report, send over your most recent template you sent, and they're just not following the detailed instructions, right? Credit repair everything is in the detail, right? Especially how we remove these accounts. It's very specific. In specific parts of your report that help to contribute these accounts coming on and coming off, et cetera, in the way they're set up. So if you're going to buy the system, then be serious about it. You know what I mean? It's not like one of these systems where you're relying on, 605 or 623 or 6, you know what I mean? It's not
all these sections.
Yeah, I mean, it's not like that. You're not just sending the same letter over and over and over again and hoping somehow, some way that it's going to work. It gives you a very clear blueprint from A to Z, how these accounts go on your report, how they come off your report. If you want to take them off, this is how you do it. And these are the steps you need to do with the templates associated in order to be able to do it. The only rub to that, though, is that the bureaus, since they're run by algorithms, don't always fall in line, right? And each bureau is independent of the next, and they look at the disputes autonomously from the next. So each algorithm that these bureaus have in reviewing these disputes is separate from the next one because they're all capitalized differently and they all arrive at that algorithm separately. So they're all unique in their own right, which is why you'll see, even when we do it, you'll see one bureau done in one round, another one done in another round, another one done in another round. Rarely do we ever see all three done in the same round. It happens, probably happens 25% of the time. The other 75% of the time, you see them done staggered, right? So that's why it's very important if she does decide she wants to do it that way, which is completely encouraged because it's a great system. It's $99. But if it is determined to do it at that time, that you got to stay on top of it. I mean, it's important. I mean, I'm not saying that it's some arduous task. I'm just saying that, like if you bought a book on how to fix your plumbing, right? Or you would want to read the whole book, right? You don't want to just read certain parts of it that seem like you can implement it immediately and avoid the important parts of it, right? Because you have a leak in 15 minutes. So I would say if to anybody that's going to buy it, just make sure you read it. It's important. I developed it myself. I put all that time into putting it together. It's like 30 pages of which, majority of them, half of them are the templates that you're sending out, but the other half is content. It's important content. It's very clear, detailed content that explains everything in depth so you understand what you're doing. You're not just holding your breath and closing your eyes, right?
But at the same time, it's been sold over, 6,000, 7,000 times by now?
It's been sold a lot. Yeah,
it's been sold a lot.
I mean,
it sells every day.
We started selling at the end of 14. So, I mean, we're now at 2019. You're almost 5 years into this, and it gets tons of. I mean, it's a good system, and like we were talking about before,
I have another question right now from Magic Matrix. He's saying, can you remove a lender off a credit profile that you currently have a loan with? Well, this could be a student loan, correct?
I think he's talking about like just a general loan, like can somebody that you're paying and you're in good standing, can you remove them? Is that what he's talking about?
Yes.
Okay. Yeah, you can. With our system, you can. I mean, I can't speak for anybody else, but I mean, we don't typically advise that because obviously, you're removing positive history, and that positive history is baked into the report, and that's not the business we're in, and removing that. But to answer your question, yes, you can. We don't like to do it. If we're doing it, we don't typically like to do it for that reason. Obviously, there's student loan situations, student loan issues that come into play. For debt to income, we talked about earlier, that's absolutely integral, for the ability for the client to meet the goal. And there's other nuanced situations, but for the broader scenario, if it's not necessary for something like that, because of the positive history, obviously we would prefer not to, because again, we're trying to leave you on a better foot than you walked in. So
correct.
But yes, easy answer, yes.
Yeah, he has another mortgage. Can you get funding for a mobile home through FHA or any type of funding that your organization offers?
For mobile homes?
For mobile homes, yeah.
I think, typically speaking, mobile homes, since you lease the land most of the time, you put it on, is more of a personal loan. It's not FHA loan. So it's not, obviously when you're going in and you're establishing a mortgage, part of the value in that mortgage, right, or in the appraisal of the property is the land itself. So when you get the manufacturer, typically speaking, and again, I know it's specific to the situation, but if it's a manufactured house that's going on leased land or land that's share owned with wherever the area that it's in, normally there's particular loan lenders, and they get booked almost like personal loans.
Ooh, okay.
that come in and will lend it, and the rate is a little bit of a kicker. It's not like lending club rates, but it's also not FHA rates. You know what I mean? You're not borrowing because the same collateral isn't there and everything like that. Now, there are manufactured houses that I've seen on land that they own where there's a little bit of an alternative situation. I think the USDA may offer it. I got to check and look. So we don't normally deal on that side, but I mean, I could check and find out specifically.
So no auto loan, he said.
What do you mean no auto loan?
No auto loan
for the mobile home?
Yeah.
Typically not. No, it's typically not set up like an auto loan. Definitely not.
Okay. I have another question from Curtis Davis. How valuable age in credit, 8 years versus 20 years in profile?
I get this a lot. In my honest opinion, I don't see much of a difference because I mean, if you're at the upper echelon, it may be the difference between you being an 800 and an 820 or something if everything is built out correctly. But the difference in that age is only applicable if you've been developing it, right? Like if you have 8 years of history, if you have 8 years of history and you have 7 accounts in your report, you have 20 years of history in the same 7 accounts. You're just doing the same thing, right? So you're not necessarily the credit you got for those accounts is already baked into the score, right? Your active scoring is comprised largely of your unsecured credit ratios. That is your active fluctuation in your scores. But he thinks they go to the car dealership and they get 2 inquiries run and their score drops 15 points. That's not what it is. It's not reality. And again, I'm not talking about Credit Karma right now, so let's not have that conversation. I mean, if it's a sunny day in your neighborhood, Credit Karma scores go up to like 5 points. Correct. I'm talking about like a real functional scoring model. If most of the time when people see fluctuations in their score on a month-by-month basis, it's typically because their credit card limits went up or their usage went up ever so slightly or a lot. Correct. Or it went down. And each one of those cards reports differently in that course of that month. So the statement date of each card is the date that card reports, or the day after is when it reports to the bureau. So if you have 3 different cards and they report the beginning, middle, and end of the month, you're going to see a score adjustment each time they pop on. Now, if they go up in usage, you're going to see it dip a little bit because it's active scoring. If they go down, you're going to get a bump in score, right? It could be coincidental. I see it all the time where somebody goes to get a car, they run a personal loan, they're like, I ran an inquiry, my score dropped 12 points. Like, no, it didn't. That's not reality. That's not what happened. You need to look at the fine details, and this is how you can arrive at the reality of the situation. Reality of the situation being that more than likely your usage went up or down. But going back to what he had said, that's where you're going to see a lot of the swing, right? I mean, if you don't have a well-built-out file, meaning a diversity of credit, mortgage, autos, paid-off loans, et cetera, up and down the line, right? you're going to be topped out around 770 without the right proper amount of age.
Ah, man, so many people reach out. I want an 850 credit score. I'm like, bro, you know how long it's going to take you to get an 850?
But there's nothing. Listen, the reality is, you don't get any special financing at 850, right? They don't say, we give the rest of the aids that have 750s, a 3.5% rate, because you're at 850, you get a 2.5, right? The financing starts to reach its tipping point around 740, right? That's considered AAA paper, right?
Yes.
So anything over that is just a vanity play. Now, I get it. I understand it.
Correct.
And obviously, if you're up there, you want it to be that way. But if you're somebody that's at 550 and you're like, I want 850, it's unnecessary, right? Because just you getting to 740 is going to change your life. You know what I mean?
Correct.
As far as being
not even 620, you get in a house. That's changing your life.
That's what I'm saying. So, you got to dial that back. And most of the time, you hear that 850 stuff from people that maybe just don't understand what it takes to get to an 850.
Correct.
Right? And how effective just a 740 is, or even a 720, or like you said, in some cases a 620 can get you into that house you've always wanted and never thought you could have. So, I don't think the age of the accounts, because of the way the models work, really changes it all that much. And honestly, when you get beyond, and any of you can test drive what I'm about to say, if you decide to add somebody to an AU
as an authorized user,
where somebody adds you to their credit card, which is,
correct,
if they have a low limit and a high limit and a very low balance and a lot of stellar pay history, when that reports to your credit report, that would give you the jump as if it was your own. So it bakes into your unsecured credit ratio and gives you score adjustments associated, right?
Correct.
If you had somebody that added you to a 10-year card with a $20,000 limit and a $1,000 balance, and somebody added you to a 15-year card, you're not going to see that much of a difference in jump, right? It's going to be almost identical, the amount that's going to jump your score when it reports.
Correct.
Right? Once you get beyond 5 years, the amount that it adjusts on those AUs age-wise is nominal. I mean, it's not like if you have a 25-year-old AU, it's going to jump your score 65 points, right?
Correct.
The unsecured credit ratios themselves, from maxed out down to zero, typically represent about a 40-point swing.
Yes.
Right? Total. So when you're maxed out, you're losing 40 points. When you're down at zero, you're actually getting 40 points that's propping up your score. That is the max in most cases.
Correct.
Unless you have a very, very, very thin file with almost no accounts, where there's no real base for it to measure against. But the point I'm trying to make is the age, I think, is a misnomer. Obviously, you need some age.
Correct.
But in my experience, when you get beyond the 7, 8, 9 years out on, it's not that much different, because those loans that come in, that scoring benefit is already baked into that they're expecting you to pay it. So it's almost priced to ideal, right? So if you make a late payment on that, you get chopped.
Oh yeah.
But it's assumed, it's baked in there that you're going to pay it. So you better keep paying it, because they're giving you that benefit, right, associated with the scoring on the loans and such. So it's important to just keep that in mind. To answer the question, I don't see much of a deviation personally in all the years and everything like that I've been doing this.
You got that, Curtis?
As a matter of fact, I don't think there is a deviation. So
I have how bad? Okay, I have a client with 20 years age, due to good standing student loans, 2 cards, while a person with 8 years has 7 cards. There you go.
You got to explain. I didn't understand that.
He says, I have a client with 20 years age, due to good standing student loans, with 2 cards, with 2 credit cards, while a person with 8 years has 7 cards.
Right.
It doesn't matter.
That was just elaboration on the earlier question.
Correct. Yes.
Okay.
So go ahead.
In those particular, I just don't. I mean, maybe the cards. Given the dynamic you're saying, I'd have to actually see, where everything stands, because it may not be related to the age. It may be related to some other things. Student loan debt can kind of drag you a little bit. So you don't necessarily get perks for student loan debt, especially if the individual's riddled with it, regardless if it's 20 years or 200 years, because it's not looked at as favorable debt. So, there could be a variable baked in there on that if for some reason it's lagging the other ones. But as far as the age issue, I don't think it holds as much relevance or significance to even notate as some of the more important areas like the unsecured credit ratios and stuff to keep the scores propped up.
Yeah. So I have another question from Gildersleeve. Not sure if you touched on this. What about investment property? Is it best to have business entities set up to get some funding?
All right, well, it's a little bit of a loaded question, but so is this individual, he's obviously trying to buy investment property, right? So there's a mortgage that needs to come into play there, but is he saying to get the funding as far as like credit and line of credit related funding, or get funding in order to purchase the property in the name of a corporation, which he's doing anyway for overall liability and tax purposes? But whatever the case may be, maybe can you just clarify what you're specifically talking about when you say in the name of a company? You're talking about like getting like credit card funding to pay for because we hear this sometimes and it's not the right way to do it, but I just want to make sure I answer it appropriately.
Yeah. No, she just said that.
She said what?
Is it best to have a business entity set up to get some funding? I'm thinking some funding, but even with FHA, you could get.
Okay, so understand something. FHA wouldn't be for an investment property. Would be the route you want to go. I mean, it really depends. That's kind of a loaded question because, in situations like that, FHA is for your primary residence, right? So that wouldn't necessarily work on an investment property.
But how about a 4-unit building that you could get? Like if it's
a 4-unit building you want to get, you don't want it on your personal credit though, because it's going to stress your debt to income ratios for future purposes, right? Because they don't give you full benefit for that. So even if you rented it, they're going to factor in the 25% vacancy factor into that. So even if you're making $500 a month on it, it's essentially going to end up pressuring you depending on the size of the mortgage, because it's going to back off of your debt to income ratio because of the formula the banks use on the vacancy factor. The way that you would have to do it, or the way I've always done it and the way you should do it, is to buy it, because there's local lenders all over the place, typically local to whatever area you're buying in, that will do commercial loans at prime rates in the name of a company, the name of a business that you set up. It can be a single purpose LLC, completely normal, whether you're doing renovations or not. They'll give you favorable financing on it. It'll keep it off your personal credit report, so that doesn't stress it. You can still report it if you want to on your personal credit, but as a single member LLC, you give yourself the tax advantage of it, plus you get the liability separation from it as well, which helps you on that side of things. So, I mean, if you're talking about, I'll go down this rabbit hole.
No, he's saying line of credit in the name of the business.
So he wants to open up like a line of credit in the name of a business to purchase property. Is that right?
Correct. Yes.
Okay. Well, that's just not sustainable. So, if the goal is to ultimately, because these are amortized, like lines of credit and credit cards are amortized totally differently than a mortgage. A amortized meaning how long you can pay it back. The reason why mortgages are great is because they're amortized over 30 years, right? It means you have 360 payments, which means you drag the payback out forever. On a $400,000 mortgage at 3.5%, you're paying roughly $1,300 a month, right? On a $100,000 line of credit completely maxed out, the minimum payment, which only a percent of it goes towards towards principal, the minimum payment is $2,500 a month, right? And that's on a true line of credit, because that represents 2.5% of the outstanding amount. It's not sustainable. The purpose of you buying a rental property of any kind, if you're not going to flip it, and the objective isn't to just, it isn't just to turn it back over in 2 months, which is still a gamble with those rates anyway. But if it's not, there's no way. You're costing yourself so much money just with the proper financing, right? Like, just do that example. $100,000. I'll just do 100,000.
Okay.
$100,000 line of credit, right? The payment on that, the minimum payment, which almost nothing is going towards principal, right, is $2,500 a month. $100,000 mortgage at 3%, right, is $350 a month. That's $2,200 difference that you're paying out through a line of credit every month, and none of it's going to principal. That $300, because it's amortized, $100,000 mortgage amortized over 30 years, the longer payback term, you're only paying $300 a month. So for argument's sake, let's say that $100,000 property is generating $1,000 a month in rent, right?
Correct.
With the 30-year mortgage, obviously, you're making $700 a month in cash flow.
I get
With
you.
the $100,000 line of credit, you're losing $1,500 a month. It's not sustainable.
Correct.
If they're going to flip it, it's a different story, right? If the idea is to flip them and everything like that, a line of credit obviously helps, because the idea is to be in and out, and if you know what you're doing, you can turn properties over. It's still a little risky, but at the same time, you can do it. On the rental side, it's not. Unless it's some sort of a home equity secured line of credit, where you have some sort of a piece of collateral to support it, where they can keep the rate down and they can amortize it longer, like a typical mortgage. There'd be no point. It would make absolutely no sense, and it would be unsustainable. You'd be it would be unless you plan on hemorrhaging on the rental until you can't hemorrhage anymore, there would be no point in doing it. And if you look, in all fairness, if you can qualify for an unsecured line of credit, you qualify for an investment property mortgage, right? There's just there would be no logical, sustainable reason to do it that way if you can avoid it.
Yeah. Okay. Are you done with answering that question?
Yeah, I mean, I think I covered it.
Yeah. No, it's good because YouTube is learning a lot. People are learning a lot on YouTube, which we still have about 23 people on YouTube. Curtis Davis says, is easy for hard money lending to put in LLC versus PG for investment property harder, but with hard money you need 25% down versus PG 3% down on investment.
Right. So, I mean, look, most of the hard money lenders, I don't know what area he's in. And I'm not, just to be clear, I'm not advocating hard money either. I mean, it's a means to an end, especially if you're getting in and out, right? Correct. Most hard money lenders, though, 25% down is absurd. I mean, if you're going in and you're going to do renovations, you can do work to it and prepare it, which is the way you should be doing it if you're going to go in and do it, right? Because you can build your own equity and everything like that. Normally, they want like 10% down, and you can wash that out through the renovation. So if it's a $100,000 purchase and you put 10% down plus closing.
He's in Georgia. He's in Georgia, Jay.
Okay. So whatever the case, these hard money lenders in these terms, I mean, they run from coast to coast. I got stuff in Philly, I got stuff down in Florida, and I've looked at stuff all the way down the coast. So at the same time, it's such a competitive market right now because the returns right now in the overall market are so low, right? I'm not talking about the stock market. I know it was up 28 or 30% this year. I'm talking about fixed income, like, a CD, the 30-year, all that stuff, bonds, etc. The returns are like 2-3%. So everybody's taking that capital and they're putting it towards private money lending, which makes it so competitive. So right now, obviously that surplus of capital and that surplus is providing a lot of supply. When there's a lot of supply, cost goes down. Correct. So maybe he's just not looking at the right lenders to do for it. But typically the lenders that I'm familiar with, if you need some, I'd be more than happy to provide it to them. But again, I'm not supporting private money lenders if you can avoid it. But are typically like 10% down again, and you can normally get out through a local lender in the name of a company. They'll refi you out if you have the equity. And again, you can wash out whatever money you have to put down on the front end if you're doing renovations through the obvious renovation scenario. Yes, private money is a low-hanging fruit in order to get any mortgage, right? Obviously, it's the easiest to get because they're basing it strictly off the equity. It's an equity play, and they're basically annihilating you on the rate, right? And the points and all the other unnecessary fees, which is why it's such a great investable product for funds to pump money out, why it's so popular right now from funds and pools of capital to pump it into this kind of stuff because it's secured against the real estate. The reality, though, is that you come into that kind of a situation and you can avoid it. I mean, if you can document your income, not even entirely. I mean, if you're actually filing income taxes and all these other variables, there are avenues to avoid other than that. And if you do have to go that route, you do have to go the private money route on the investment side. Make sure that you have set up an exit strategy in place, meaning a local lender, commercial lender, a lot of local credit unions, local neighborhood banks and stuff. They love doing the local stuff that they'll refi out in the name of the company. There's even, believe it or not, now there's actually no doc loans in the name of companies. Velocity is a very popular one that does it. There's a number of them that do it now where literally you need to document your income, and as long as you have the equity in the property, they'll get you out of that hard money loan. They'll get you down. It's still going to be like 6 or 7%, but it's not going to be 12 or 13 or 14 you're paying to the private money lender. But obviously that tick up in rate is associated with the tick up in risk because they're not having you document the income. So what I'm trying to make is there's so much money in the system right now. There's options everywhere. You don't need to just settle for the low-hanging fruit. If you do a little bit of research, you can find the right scenario, and you have the proper guidance.
Correct. Gildersleeve said, I definitely chose the wrong term, line of credit. So a commercial mortgage.
Okay, so on the commercial mortgage side, yeah, without a doubt. I mean, it would. That's the way to do it, right? So in essence, if you're going to get into whether it's a rental or even if it's a renovation, you're going to want to do it in the name of a business. Preferably, if you don't have any partners, a single purpose LLC would be a good way to do it. And again, there's a lot of local community lenders that will do renovation to perm loans. If you're doing renovation, right, in the name of the business and in the name of the commercial entity, they'll do renovation to perm if you're planning on doing work. If not, They'll require a certain amount down, but they will do it in the name of the company, and they'll do a local, right? Because they want to. Part of the prospectus with a lot of these local areas, when these banks sprout up, right, and they're community banks, part of the prospectus is they need to invest a certain amount of money into the community. I mean, they're required. It's not optional. They raise a lot of the money, and a lot of the money that some of these banks raise is raised locally with the idea that they're pumping it back into the community. So, you would be remiss not to take advantage of some of these community credit unions, which lend aggressively in these areas because they have to spawn development in the area, right?
Correct.
That's the purpose of them being there, is to help facilitate growth, whether it be on the commercial end, the residential end, etc. So you would be remiss not to utilize them, but it would definitely be the right way to do it. We'll do it in the name of the company for tax purposes, for liability purposes. And they do definitely offer them, and they do it even on the commercial side. It might be a tick up, like a hair up from like a residential prime rate, but it's not going to be, if you're getting quoted 3.5 on the residential side, you may see 3.8 on the commercial side. So it's still beautiful rates. It's not, and that stuff that they portfolio, there's no secondary market for that, meaning they don't fund it and then sell it to Wall Street. There is no commercial loan, Fannie and Freddie. So that's stuff that stays on their books. So you deal with them the entire time, which is good because it allows you the opportunity to facilitate a relationship with that particular lender as you grow your real estate business. So it's good.
Okay, John, I know we're pressed for time, and we got one more question to answer, and then we're going to log off. But check this out.
Okay.
Brian Taylor says, what's the best to make my credit repair, an LLC or corporation?
Man, again, I'll give you the general answer, and then you can figure out how it works for you specifically. But generally speaking, right now with the new tax bill that went into effect in 2018 with Trump, it favors pass-through entities, right? So an LLC is typically, if you're set up like an S corp or something, it's going to pass through. So whatever profit you show on that LLC, that income then reports on you. Pay no business income tax or business revenue tax. You end up paying that tax on your personal income tax return, right? But the way that the new tax bill went into effect is, let's just say, for argument's sake, you showed $100,000 net income, right, on your LLC, on your LLC 1040, and it passes through to your personal income tax return. There's a thing called a QBI, it's qualified business deduction, where they take 20% off the top of that. So, and instead of $100,000 coming over to you on your personal income tax return, it'll only be 80, which is huge because at a 25% tax bracket, that's almost $5,000 in savings on tax that you would pay because of that tax advantage of the qualified business exchange. So I would say the corporation you don't allow that with a corp because the corporation basically houses the profits. And in some cases, it serves you better to pay yourself a salary. And I don't know if you want to pay yourself a salary. I don't know how your situation works, but if your objective is to avoid taxation, and you're running a reasonable sized business, my personal opinion, I would say go the LLC route and do, a pass through for the purposes I just explained, because there's not many other scenarios where you can actually take a 20% write off of your net income of your business income before it goes back to your personal income, in savings, because that can be significant the more money you make. Even though less money you make, so relative, you're getting a 20% exchange there that's actually assisting you and overall helping you before you even mark down your personal tax deduction. So that would be my suggestion.
Okay. Well, Brian, I hope you got that information. Still a lot of people on YouTube. Just want to say thank you guys for logging on. As you could hear the all the information that we've shared. John has knowledge with it, and we actually position people to do everything that we talked about, which is mortgages, vehicles, credit repair. Is that right, John? We can help people get into a mortgage if that's the case, or an investment property.
Yeah, absolutely, we can help on any area. That's what I'm saying. Like that's. We pretty much have, but as far as on a larger scale, we can help in any financial, like tax issues, school loan issues, all that stuff is stuff we've helped clients with. And obviously it's case specific on the individual, but there really hasn't been a situation where we have been able to guide people through. Obviously every situation is unique. Every client that comes to us is unique, and the result is unique, and the structuring is unique. But yeah, we can help in any instance. We covered a lot of different areas on this particular, cast today, which is good.
But it was all a lot of mortgage related questions, which that's what this whole podcast today was about: how to get you mortgage ready 2020.
Yeah. So I mean, but we touched on some other things that can maybe open some eyes. But yeah, at the same time, we can help in all those areas. Absolutely.
Okay, so again, guys, my email, GizzyCredit@GizzyCredit.com. You already know. Over here, I put it on my Facebook, and I also put it on my YouTube. Just want to say thank you guys for listening. And then a lot of you are people who've been following me for years. Thank you so much for liking the content and sharing the video as well. Helps us out a lot tremendously, helps the channel grow, and more people could get accurate information about how credit works, especially here with John. Shout out to John. Thank you so much, John. We will be in the new year having more live podcast talk, and we could be cover a whole range of things from credit to mortgages to saving and taxes, saving people from what is it, the George character, John?
The George character. Oh, you mean you're talking about the garnishments?
Garnishment. A lot of people, some people.
Yeah, we get a lot of. Let me just talk about this real quick. So we get, and this is stuff we'll talk about in a later one. But we get a lot of clients who've just been avoiding, and just general callers where they've been avoiding their school loans forever. And essentially, what ends up happening is the Department of Education, Navian, et cetera. They basically put the foot down and say, "Look, we're going to start garnishing your wages," and people don't take them serious. They take their tax return money. They take they garnish their wages until they get them back to the table. People just don't know how to get from the garnishment stage back to functioning, and we've helped a number of clients do it. It typically takes, we know the whole process inside and out to get them in and out of the garnishment and get the garnishment lifted. So it's a tedious process, but it's a process we've done, and we can get it done quickly. So if there's anybody that's in that situation, we'll talk about that in a later podcast. But it's like I said, every situation we've helped and we can work through over and above just the general credit repair. Credit repair is always part of the process, always the first step. But typically speaking, it's the first step of a much broader process.
Correct. All righty, John. Anything else you want to say?
No, that's all. Thanks, everybody, for listening.
Thank you, everyone, for listening, watching. Thank you so much for liking the videos. I'll see you guys in the new year. Happy New Year. Thanks, John.
Yep.
See ya later, my people. Happy New Year. I don't know if I'm going to do this the new year because I have somewhere to be. But the more topics you guys shoot me, the more we discuss them. Okay? Again, John is 15 years, real estate investor, very knowledgeable. I get a lot of my customers. You have been my customers. And these are the questions that you want answered. So most definitely, we'll hear for you 2020 and already in business 10 years plus. Thank you so much for watching. I'm going to see y'all later. Peace.